Hi, in this video, I'm going to spend some time talking about what bonds are and contrast them to stocks. So stocks and bonds are the two primary ways that companies raise capital. And what I'm going to do is I'm going to share my screen with you so you can see just a quick visual. So stocks are usually the security that we're most familiar with. Stocks are most commonly covered in the media, and that we speak about stocks the most with friends and family when we talk about investing. Stocks are effectively an ownership share of a company. A stockholder has unlimited upside potential. They share in the capital depreciation of those shares. So if they eventually go up in value, they can sell them down the road and earn a profit. If a company eventually issues dividends, then the shareholder has the right to participate in those dividends. The stockholder, though, also has unlimited downside. So if the company fails, the stockholder may not get anything. So the stockholder certainly is taking on a fair degree of risk in exchange for the upside potential that they have. Bondholders, on the other hand, they are lenders to a company. So a company, instead of issuing new shares, they can issue bonds to raise funds for business operations, for big projects or initiatives. What bondholders are doing is they're lending their money over the term of a bond, and that can be several years. And in return for lending their money, bondholders receive two things. They receive interest payments, and then they can also expect to receive their lent money or their principal back at the end of the bond term. The other thing that bondholders have is they have more rights than shareholders in the event that the company goes bankrupt. So if a company fails, then the bondholders are first in line, or certainly before the shareholders, to get their money back in liquidation. So overall, the expected returns of stocks, and the historical data supports this, the expected returns of stocks are generally higher than the expected returns for bonds because the stockholder is taking on significantly more risk than the bondholder. The other major player in the bond market that's not shown in this chart is governments. So since governments can't issue share capital, you can't purchase ownership shares in a government. Governments still do need to raise capital in order to fund their operations, and they do that via the bond market. So governments are a major player in the bond market, not illustrated in the chart that I just talked about, but we will talk about governments and the role of government bonds in future videos in this series. So hopefully this short video has helped you understand the primary differences between stocks and bonds. If you like this video, give it a thumbs up. For more videos in this series, you can check the description below, and I will speak with you soon. Take care.